Welcome to the CoinViewer Weekly Crypto Review. Here are the top stories in crypto this week. Crypto's recovery rally. Coins and tokens see their first week of green in over a month, despite concerning macro and crypto news. Why the red could come back in a couple of days. Peculiar Ethereum updates. The second biggest crypto sees its second largest number of daily active users as it pushes towards decentralization and launches a new testnet. What does this mean for ETH? Binance troubles Brewing. Binance US cuts off a third of its staff, while the CEO and other top executives resign, and the SEC files a motion to unseal court documents. How could this impact the crypto markets? Currency crisis imminent. The Chinese yuan and the Japanese yen collapse against the US dollar due to rising long-term interest rates. When will something in the financial system break? And a closer look at last week's top-performing cryptos and where they could be headed next. All this and more in just a moment. Good morning, afternoon, or evening. Thank you for tuning in. My name is Jessica, and for those that are wondering, Guy will be back in tomorrow. For the time being, you should know that what you're about to see is educational content, not financial advice. You can find any of the topics that you're looking for using the timestamps in the video timeline. And now for today's top stories. Last week, the crypto market mounted an unexpected recovery rally. In retrospect, it was long overdue. Many coins and tokens had seen 4 straight weeks of losses. Even so, it was unexpected because it occurs despite all of the bearish macro and crypto-related headlines. On the macro front, inflation figures for August came in higher than expected. This should have been bearish for the crypto markets because it does suggest that the Fed could continue raising interest rates in response to this rising inflation. And yet, most coins and tokens barely reacted. On the one hand, this isn't surprising because the crypto market hasn't been nearly as correlated to the broader markets over the last few months. On the other hand, it is still surprising because the factors that's causing this inflation is rising energy prices, a problem that only seems to be getting worse. This ties into the reason why the crypto market could flip from green to red in the coming days, and that's the Fed's upcoming press conference. If you follow our weekly newsletter, you'll know why this press conference is so significant. Be sure to subscribe so you don't miss the next one. The link will be down in the description below. Now onto the crypto front. There was no shortage of headlines related to regulatory scrutiny. Most of these headlines were about Binance, which I'll come to later. That said, there were a few headlines about other crypto exchanges, namely Bybit, which could soon be exiting the UK. If you watched our recent video about the FATF's infamous travel rule, you'll know that it was recently implemented in the UK, hence why many crypto firms have started restricting support in the country. You'll also know that the travel rule will be rolled out in other countries in the coming months. At the same time, the courts gave FTX the green light to liquidate up to $3.4 billion in crypto as part of the exchange's bankruptcy proceedings. According to Cointelegraph, FTX will be allowed to sell $50 million of crypto in the first week and then $100 million in all subsequent weeks. Given that this ruling was made last week, that means the real sell pressure could begin this week. According to Messari, FTX's largest holdings are Solana, Bitcoin, Ethereum, Aptos, Doge, Tron, and Polygon. The silver lining is that its sole holdings are still vesting, meaning they can't all be dumped. Regardless, it looks like crypto is about to experience a lot of selling pressure, particularly alts. This would explain why BTC has been strong compared to most altcoins. As you can see, BTC is back above the Bollinger Band moving average on the daily. This is a bullish sign, at least for the short term. However, BTC is still below the Bollinger Band on the weekly. As Guy has mentioned many times before, the Bollinger Band moving average on the weekly has basically been the line in the sand between being crypto in a bull market or crypto in a bear market. Being below means bear. What's more alarming is that ETH has continued to struggle against BTC and is painting a very different picture on the price chart on the daily. As you can see, ETH appears to be having a hard time getting above the Bollinger Band on the daily, If this turns into a rejection, ETH could crash. The prospect of an ETH crash isn't that outlandish given the circumstances, but I suppose it depends on which circumstances we are talking about. For example, Ethereum recently hit its second highest daily active user count in over 8 years. Almost 1.1 million unique wallets were active last Wednesday. Some believe this is a bullish sign, given that Ethereum recorded its highest daily active users in December after the FTX collapse. In the months that followed, ETH recovered. However, others could believe this is a bearish signal, especially since lots of ETH has been sent to exchanges as of late. Not only that, but there has been increasing concerns about Ethereum's centralization ever since it transitioned over to proof of stake. As reported by CoinDesk, over 70% of staked ETH is being staked with third parties, such as exchanges and liquid staking protocols. Of course, there are only a few of them. That's why crypto projects such as SSV Network have been introducing new protocols and blockchains that hope to address Ethereum's centralization concerns. In SSV's case, it's using a novel blockchain that makes it possible to decentralize ETH staking using a novel protocol. A topic for another video, no doubt. Ethereum itself has also been looking to improve its decentralization. If you watched last week's crypto review, you'll recall that the creator Vitalik Buterin has been working on ways to make node hosting more decentralized. Ethereum is also turning to focus on privacy, which is equally important in our opinion. Obviously, all of these ambitious upgrades are going to involve a lot of testing. As it so happens, Ethereum recently launched a new testnet dubbed Holsky. As explained by Cointelegraph, Holsky will focus on staking, infrastructure, and protocol development. By contrast, Ethereum's other major testnet, Sepolia, will continue to focus on dApp development. What's concerning is that the launch of the Holsky testnet was reportedly botched, meaning Ethereum developers had to shut it down shortly after its release. Holsky is expected to be rebooted at a future date, though the exact date has yet to be announced. Issues like these are probably why crypto asset managers like CoinShares are starting to notice that investors are increasingly turning away from ETH and towards other altcoins. As we also mentioned in last week's crypto review, Solana seems to have taken the spotlight as the runner-up. The thing is that most of Ethereum's competitors are exponentially more centralized in almost every possible way. Logically, this allows them to move a lot faster, but it also increases risks of multiple dimensions, including development and regulation. This is something that investors seem to have forgotten. As such, one could argue that an increase in interest in so-called Ethereum killers will be short-lived, but this ultimately depends on what happens with the rest of the crypto market over the coming months. If retail speculation returns, Ethereum killers could continue to see significant interest indefinitely. If what's left of the retail speculation continues to dissipate, though, then ETH could eventually start to regain the market share that it's been losing to its competitors. If you watched our video about the crypto bear market, you'll know why this could be why ETH didn't rally more during the bull market. In any case, there is another critical weakness that Ethereum killers have, and that's most of their market activity is happening on offshore exchanges such as Binance. To be clear, this is a critical weakness and not unique to Ethereum killers. It's true for most altcoins, particularly privacy coins. That's why the regulatory scrutiny of Binance is not something to be taken lightly. Don't get me wrong, there has been no shortage of FUD about Binance coming from anti-crypto media lately. However, this FUD is starting to turn into something that could do some serious damage to the crypto markets. For starters, the CEO of Binance US has resigned along with its key executives, including its head of legal and chief risk officer. For context, this news comes shortly after other Binance executives in other jurisdictions resigned. Never mind the fact that Binance US will be firing a third of its workforce. At this point, it's clear that something is up, and the headline suggests that this something is related to US regulations. Beside the rumors that the Department of Justice is investigating the exchange, the SEC has recently filed documents under seal in its ongoing lawsuit against Binance US and its affiliates. It's believed that these documents signal that a criminal probe is underway. We could find out as soon as this week whether this belief is justified. That's because the SEC received approval from the courts to unseal some of these documents last Friday. Note, an exact release date has apparently not been set. But if these unsealed documents show that a criminal probe is underway, then the crypto market could experience a temporary panic. The possibility of this panic is precisely why the DOJ has been so hesitant to announce official charges against Binance, at least according to some reports back in August. For reference, Binance accounts for almost 50% of crypto trading volume on the spot market. For hundreds of smaller coins and tokens, this percentage is over 90%. Any disruption to Binance could therefore be devastating for the crypto market and deadly for these smaller projects. The good news is that this would simultaneously cause most of the crypto trading volume to shift from offshore exchanges to onshore exchanges such as Coinbase. This would theoretically increase the likelihood that the SEC would approve one of those spot Bitcoin ETF applications. The bad news is that this could mean the end to many promising crypto projects that regulators have actively been trying to kill, such as privacy coins. It would also lead to even more control of the crypto industry and potentially pave the way for a world where it's not possible to withdraw crypto from exchanges. For what it's worth, it's very unlikely that Binance or any other offshore crypto exchange will go down. It's safe to assume that the exchange that has made it this far has proved their resilience. The primary consequence would be a reduction in market share and an increase in compliance. Issues of offshore exchanges could also be present for another buying opportunity before the next crypto bull market begins, maybe the last. If you watched yesterday's video about crypto potential, you'll know the returns of the next cycle will be unprecedented, assuming its prerequisites are in place. On that note, one of the prerequisites for crypto to really reach its full potential is that people's faith in fiat currencies declines to the point that they start to look for alternatives. This process is in play in just about every country, though it's much further along in some than others. The big-name countries in this regard are the likes of Argentina and Nigeria, where hyperinflation has evaporated the purchasing power of their national currencies, and government corruption has eroded trust in national institutions. As crazy as it sounds, countries like China and Japan, they could be next. This is because what's been going on with their respective currencies. If you watched our video about China's new central bank governor, you'll know that he was put into his position to prevent the yuan from plummeting. The chart suggests that he is about to fail miserably. As you can see, the yuan is on brink of breaking below a key level of 13 US cents. If it does, then it will fall to levels not seen since the early 2000s, when China was still an emerging economy. This seems inevitable, given that China's economy is weak, and any kind of stimulus will further devalue the yuan. It's a similar story with the Japanese yen. As you can see, it's likewise on the brink of breaking below a key level of 0.0068 US cents. If it does, then it will fall to levels not seen since the 1980s. Just to put things into perspective, the Japanese yen has lost a third of its value over the last 2 years alone. This begs the question of why the Chinese yuan and the Japanese yen are so weak. The short answer is because the US dollar is strong, which begs the question of why the US dollar is strong. The answer is because of interest rates, specifically the difference in interest rates between the US, China, and Japan. In case you missed the memo, the Fed has been aggressively raising interest rates to fight inflation since last spring. By contrast, the Bank of China and the Bank of Japan have continued to keep interest rates low. But this only explains why the yuan and the yen crashed so much last year. It's only half the story. The second half of the story is rising long-term interest rates, in contrast to short-term interest rates, which are set by central banks. Long-term interest rates are set by the free market. When long-term government debt is sold, longer-term interest rates in the economy will rise. What's crazy is that in this case, it's the Central Bank of China and Japan that are selling US government debt for US dollars to buy the yuan and the yen to prevent their prices from falling further. This is having a paradoxical effect of raising long-term interest rates in the US, which is making the USD stronger. Case in point, the DXY has been strongly correlated to the long-term interest rates in recent months. As long-term interest rates go up, the DXY rallies. The interesting thing is that the DXY consists of primarily the euro and the British pound. Lo and behold, both currencies have been weakening against the US dollar too. Put simply, the central banks of China and Japan are selling US government debt. This is causing longer-term interest rates to rise, which is pushing up the US dollar. That's because everyone with US dollar debts, which is everyone, must also find more US dollars. This increase in demand is causing the US dollar to rise. If this dynamic continues, it could start to do some serious damage to the stock market and the crypto market. However, it could also start to do some serious damage to US government bond markets. If this happens, then the Fed will have no choice but to stimulate. But we will probably see a lot of pain before that happens. Anyway, last week, top performing cryptos were Toncoin, Thorchain, VeChain, MakerDAO, and Bitcoin Cash. Starting with Toncoin. Ton appears to have pumped because the popular messaging app Telegram integrated the Ton crypto wallet. At the time of shooting, Ton is struggling to get above the key level of $2.50. If it can break above this level, then it could possibly retest its all-time highs. However, this would likely require another big bullish catalyst. In the absence of this catalyst, a rejection seems more likely. Next up, we have Thorchain, whose Runecoin appears to have pumped because of the cross-chain DEX's integration with MetaMask. This integration was made possible by a so-called Snap-on, a browser add-on provided by Shapeshift, a crypto wallet which leverages Thorchain. Rune is looking incredibly bullish on both the daily and the weekly charts. That's because the Bollinger Bands appear to be squeezing to the upside on both timeframes. The caveat is that Rune is extremely overbought and struggling to get above $2. As with Ton, a rejection could be coming for Rune too. When it comes to VeChain, the reason why Vetcoin is pumped is easy to identify. Vet was finally listed on Coinbase. This is something that many Vet holders have been waiting for. If history is any indication, this could set the stage for even bigger gains for Vet in the future. The caveat there, though, is that Vet is looking extremely weak on the weekly. It was rejected by the Bollinger Band moving average and seems to be at risk of squeezing lower. From a fundamental perspective, Vet's traded volume on Coinbase is a fraction of what it is on other exchanges. Not a good sign. Regarding MakerDAO's Maker token, some of you will recall that the decentralized stablecoin protocol recently introduced a buyback mechanism. This means that it's not really possible to analyze its price from a technical perspective. From a fundamental perspective, though, DeFi seems to be struggling. Just something to keep in mind. Finally, we have Bitcoin's Cash, whose BCH coin pumped for unknown reasons. Our best guess is that it has something to do with PayPal's recent Ledger wallet integration, which made it possible for verified users to purchase multiple cryptos, including Bitcoin Cash. As you can see, BCH is looking quite strong on the weekly, in contrast to BTC. It's actually moving above the Bollinger Band average on that time frame. Even so, it seems to be losing momentum, and the more it tests that moving average, the higher chance that it will break back below it. Note, if you want to know why cryptos are pumping in real time, you can join the Coin Bureau Telegram channel. It's completely free and packed with alpha. The link will be in the description. And that's all for today's Coin Bureau Weekly Crypto Review. If you enjoyed it, then you know what to do. Hit that like button, subscribe button, and bell icon too. Don't forget to check out our deals page, where we have massive discounts and airdrop bonuses of up to $40,000 on some of the best exchanges, only for the viewers of this channel. You can find the link to that resource and many others in the description below. Thank you so much for watching, and I'll see you in next week's episode.